We start today's market talk. By end of the week, the markets have reached a new high and the VIX has gone back to sleep. This week, bears had multiple opportunities. Economic survey had talked about unpredictable global environment, kept GDP growth at 6.5 to 7%. It said financialization of economy has not ended well, giving an example of global financial crisis of 2008. And then the budget unnerved the market by changes in capital gains tax and STT. But did the equity markets listen? They soon shrugged off the problems because you can't stop a raging bull. Market outlook. The budget stayed the course on fiscal consolidation. Policy continuity has been preserved. Roads, railways, and defense continue to attract more allocation. Uh, Fiscal deficit is estimated at 4.9% of GDP. So there is less of fiscal stimulus. Total expenses budgeted for FY25 was up 8.5%, less than 10.5%, which is the nominal GDP growth assumed for FY25. So the government is spending less. Revenue expenditure was up 4.8%, barely beating inflation. So the thrust on capex continues. Civil construction and water projects should benefit. Capex kept at 3.4% of GDP at 11.11 lakh crore. Construction of roads and highways retained. Interim budget amount of 2.78 lakh crore. Hence, the basic policy continuity has been preserved. Uh, Stocks which will benefit from small changes in the budget are the ones which are important for digitalization, land record management, water treatment, housing finance, reduction in duty on leather imports, and infra stocks. So the changes in capital gains and security transaction tax have not altered the bullish outlook. Government had cut custom duties on gold from 15 to 6%. Uh, it may also happen that the government may scale back on even discontinue with sovereign gold bonds. In FY23, gold imports were approximately 2.8 lakh crore. At 15% import duty, the custom duty would have come to around 42,000 crore. So it is unlikely the government is ready to give away around 10,000 crore just to save 1,000 crore or 100 odd crores, which they would have to pay as additional amount on sovereign gold bonds, which are due to be redeemed in next few months in August, I think. And because initially, when the sovereign gold bonds were initiated in 2015-16, the size of a gold bond used to be around 10,000 to 1,300 crores only. It is just now, once the gold prices have gone up, the sizes have increased. And last year, they collected around 27,000 crore through sovereign gold bond. Right now, the reason could be that the government is not anticipating a problem of current account deficit, as dollar is expected to weaken, and also gold is an important employment generating sector. And as the banks and other central banks are moving towards gold as a substitute in reserves to dollar, and if the dollar is going to go down, the RBI would have preferred now to acquire more gold, and then they would like to buy gold at a lesser price. So maybe raising the duties have been reduced for that. One additional good point of budget was that the government borrowings have been projected to be lower. So that will be an additional reason for the rally in the bond market. RBI in a draft circular on Thursday has proposed that banks must set aside more reserves from 1st April 25 towards liquidity coverage ratio against deposits that have a digital enabler attached. It means that the term deposit you opened online will require banks to invest more in government securities. The regulator wanted banks to take lesson from the SVB debacle in US. Hence, setting aside more reserves meant they will have less money to lend. But the high credit to deposit ratio issue, which was bothering the RBI, will now come under control as banks will be able to lend less. So the NIMs of the banks otherwise will shrink. So what are the options for the banks? They have to go for more deposits. So there would be increasing fights for deposit to keep up with their credit growth, which they have planned for. Like, interestingly, on this Wednesday of this last week, the US markets had a 1 trillion loss because of fall in the uh, NASDAQ and all the mega tech stocks. A reality check on basis of fundamental earning growth more often than not has punctured bubbles in equity markets. Results announced by some mega tech companies are below expectations. Tesla, Alphabet missed profit estimates. Also, there is a rotation of funds from tech to mid and small cap stocks with which are having stable earnings and reasonable valuations and which will be benefited in a lower interest rate environment. So the big question is if the AI frenzy which was there as which has been seen in this year will cool off or not. But it is too early to call this because still the Nvidia results are still to come. Now, talking about US, so the two key parameters to see for US are the US bond yields and the dollar. Now, the bond yields went down uh, last week as was expected, and S&P 500 ended the week 1% lower due to sell-off in tech stocks, while Russell 2000 was up 3%. People are looking at the latest monetary policy meeting of the Fed, which is there next week, which will give a direction for rate cut in September. While US GDP growth accelerated in Q2 and was higher than estimates, highlighting a resilient consumer and more business spending which is taking place. So if you see here, the bond yields went down and now they are below 50 EMA and expected to go down further. In addition, they're making lower highs, sorry. They're making lower highs, which indicates that they're expected to go down further. And moment there is a clarity on one rate cut, it will at least go down by 25 basis points from whichever level it is. So it is expected to go down to around 3.8 level. Dollar index also corrected and now it is below the 50 EMA. So it's now at around 104 level and it is also expected to go down further to around 100 level. Crude has corrected and now it is below the 20 and 50 EMA and has come down below $80. So as there is a declining trajectory now, it is expected to go down further. Gold went up, corrected, and then consolidated basically. So it's at the 2400. But in case in a falling interest rate environment, the gold is expected to always do well. Copper corrected and has come below its 20 EMA. So I don't think there is a copper super cycle, etc. But again, in a lower bond yield and lower dollar environment and lower interest rate, the metals, base metals, precious metals are always expected to do well. S&P 500 have had two consecutive red candles. So this week it corrected around 1% and will test, I think, the 20 EMA and then we'll see what happens from there. India VIX also declined. There's a daily chart. So if you see, it came down drastically after the budget was announced. And now I think it will gradually go down because I don't think there is another event risk which is coming up. Come down to around this 10 out level where it generally takes support at. India's government bond yields also corrected and have now come to 6.94. As I had spoken about Nifty 50, if you see here, uh, this weekly chart, this is in a rising channel, which is having constantly up higher highs and higher lows, and it has broken out through this last week, and it made a fresh high on Friday. And if you see the daily chart, it tested the 20 EMA, and then it rose from there, and then it went to around 24. It made a high of 24860 uh, last week. So right now there is good momentum, and this was a very strong candle on Friday for Nifty. So this is looking good, and it is basically held because there is a sector rotation which is taking place, which is providing continuity to the bull market. The amplitude of this up move is very strong, so this momentum should take Nifty to immediately in a short term to 25,050 to 25,150, and then after this it can go anything to 25,650 to 25,680 levels from here. This is after drawing a Fibonacci extension from the this week's low to the this week's high. So let's see from here. Nifty Bank, it was that underperformer, and it had three continuous red candle. So Nifty Bank needs to catch up with Nifty because Nifty is leading the rally, but it is Nifty Bank which is going down. It is now testing the trend line, upper trend line support of this rising trend line which is there. So we'll have to see where it is going to move from there. DXY, that is dollar, saw consolidation, but rupee also weakened against dollar, and that should be to be seen now. Crude and natural gas prices also fell. So Nifty Bank, if you see here, has had 3 straight weeks of fall, and on daily charts, it went below 50 EMA and then rose back on Friday. So whether this is some kind of a relief rally, or we'll have to see that, whether there is a follow-up action and it can go above 20 EMA. That has to be seen. That is another 600, 700 points from here. So that has to be seen. HDFC Bank didn't do much last week. It was stable, and it has to trade above 1600 for some support. In case it breaks 1600, it will go to this 1540, 1550 level, where last time it had taken support and consolidated for a long time. So we'll have to see that. Reliance has broken through that few weeks back, had broken through that supply zone and had gone to 3000 plus level, but has corrected based on results. And now it has come, it took support at 20 EMA, but bounced back from there. So if it trades above 3000, then it will remain positive. Otherwise, it may test this 2960 or the 20 EMA level. The stock which was in momentum is IT stocks and Infosys. It led the IT rally and to a fresh high. So it has made a higher high now. In January, it went up and then corrected after results. And now before the results, the rally started, and now it has got support with the results. So this is expected to do well now. Nifty IT index made a good cup and handle, and now it has broken out. So we'll have to see that up to which level it goes. But it is now near its all-time, above its all-time high. So this is at lifetime high and is expected to do better. Normally, the rise is the depth of this from where this rally started. So if you see, the depth is roughly around 13,000 odd points. So if the rally started at 31,000, so this can go up to 44,000. Nifty Midcap Index bounced back later, though it had corrected during the week. and now it has reached a new high and it made a engulfing candle. So this is looking positive and showing momentum. Small cap index also bounced back. So let's see if it can make fresh high, uh, because this is where the basically the portfolios are there are impacted. So that will benefit the portfolios. Uh, so we'll have to see if the Nifty bank catches up with Nifty in the coming week, and sector rotation is taking place. So one is the sentiment which is helping drive the markets, and because of which the bull market is continuing. And rate sensitive because of this impending rate cuts should do well. That is auto, real estate, metals, etc. So watch out for them. Now I'll cover few stocks. First is AU Small Finance Bank. It received board approval to apply for universal banking license. Transition to universal bank could be structurally positive for AU, as some of the restriction guidelines under small finance bank rules would be removed. And as it is, people have more confidence in case there is a bank, which is a universal bank. Advances grew 3.4% Q on Q on merged basis, and it highlighted that disbursement across products remained strong in Q1 FY25. Addition of high-yielding book due to merger drove NIM expansion. Management expects credit growth to remain robust at 25% in FY25. Expect deposit growth to remain at 25% year-on-year in FY25, with containing increase in cost of funds at 35 to 40 basis point. GNPA increased marginally to 1.78% versus 1.67% Q-on-Q, with stable PCR at 65%. Similarly, net NPAs increased to 0.063% versus 0.55% Q-on-Q. Asset yield is showing encouraging trend. May see upside risks to FY25 NIM guidance at 5.5. So it is expected to have higher NIMs, and higher NIMs is because of it had acquired a, a NBFC, which is FinCare, and which has helped it improve its business and sell good products. So this is their financial summary. So if you see, they are net interest income is expected to grow around 20% year on year from here. Operating profit is also expected to grow similar levels. EPS is going to be around 37.6 in FY26. So there's a healthy growth of around 15 to 20% CAGR. P is come down. It was to be expensive, and price to book has come down from 4 or 3.8 levels to around 2.4, which is reasonable. The book value in FY26 is expected to be around 250, 260. So it should trade at around this 2 to 2.5. So 2 to 2.5 will take it to around 650 odd levels. GNPA are under control. ROA is improving now to 1.6, and ROE is also improving to around 15 level. If you see their quarterly results, the loan AUMs grew 22% and 42% year on year, which is strong. Yield on loans has improved. Cost of funds is stable at around 7. So the NIMs improved very nicely in this quarter. The total deposits have also strong. CASA ratio is good, is stable. Provision coverage ratio is also decent, and they have added roughly 2,000, double their branches, 2,414 branches now. So they have nearly doubled their branches in 1 year. And if you see even Q and Q, so they are on expansion spree. Credit growth stood at 3% Q on Q for merged entity, which they have done with this FinCare. Gross advances have grown, and Q on Q growth is very strong, which is now around 25% plus. The loan mix is basically dominated by vehicle finance and security-based lending to MSME. So this is relatively secure, and this is giving them good returns. Cost to income ratio has come down. which is positive. Slippages increased due to seasonality, leading to rise in GNPA, but it's not gone up too much, so it has to be watched this and how much provisions they are doing. So that impacts their profits. Performer numbers for merged entity have improved. So the deposits, they had merged with Fincare. So the deposits, gross loan portfolio, cost of funds has come down. Balance sheet, net worth, customer acquisition, the customers have increased, nearly doubled after merging, so which is very positive. Employees have also increased and touch points have also increased, so nearly doubled. So this will help them do cross-selling and grow their business. If you see their chart, now this was consolidating and had come down below the 200 EMA, which was at 657. Now it bounced back on Friday based on this news of applying for universal banking license. So anywhere which close to 600, if you get this stock, this should be a decent opportunity for long term. Next stock is United Spirits. Their prestige and additional other segments, volume grew by 5.1% year on year because prestige is a premium segment with value growth of 10% year on year. Popular segment volume was down 4.6% year on year with 2.7% year on year drop in value. Company has obtained price increases in many states in the last 1 year. In the current quarter, price increases received in UP and canteen stores. Approved investment in two companies, V9 Beverages Private Limited, Sobel. They make this sober gin, rum, and whiskey. And Indie Brews and Spirits Private Limited, Coffee. They make this coffee liquor. So both of them should help increase their revenues and business. Ongoing premiumization in the spirits market and the fact that 87 to 88% of the company's sales now come from the prestige and above category is helping their margins and improving their business and profits. Recent efforts on innovation and renovation, entering into new categories like tequila, investment in their own local brands are also enhancing long-term growth prospects. ENA is extra neutral alcohol, remains inflationary, prices tend to go up, while other raw material costs have remained stable. Likelihood of reduction in tax slabs in Karnataka, the largest spirits market, and resumption of business in Andhra Pradesh and UK, India, FTA are key events to watch. So some of their brands are doing very well. So the advantage to them from the budget was one, tax stability. Then their prestige and above segment is doing better. Volume growth is decent and margin is expanding, which has led to higher EBITDA margins. And there is a K-shaped recovery which is taking place in the economy, which is helping their prestige segment and helping them improve their margins. Removal of GST on extra neutral alcohol, which is an ingredient for making all the spirits for human consumption in the budget, will reduce taxation part of their expenses. Among their brands, Royal Challenge is doing well. McDowell #1 has been revamped. Johnny Walker's sales are good. Don Julio Tequila has had a good response. Godawan single malt will have national launch. It is launched in, I think, North India. FTA with UK will lower bulk scotch duties. So the pricing of all the Diageo brands, all the premium scotch will come down by 5 to 15%. Now let's see their performance. So if you see the Q1, the volume growth was strong, 3.5%, so which should overall help them. They are expected to improve their volume by 4% next year. Revenues are expected to go up by around 11 to 12%. Gross profit is improved. Margin is now 44%, which is good. EBITDA margins have also improved. So they're expected to be strong. And EPS is expected to be around 19 to 20 over FY 25-26. So FY 26, they're expected to do around 24 rupees EPS. So at 60p, they should trade at around 1450 to 1500, which is decent. They're expecting a revenue growth of around 12 to 13% over the next 2 years, EBITDA growth of around 15 to 20%, and profit after tax is expected to be 1750 crores uh, in FY26. So a PAT margin of 13% and a growth of around 25% over FY25 in FY26. So FY26, they're expected to do better with the EPS of 24. ROE, ROC are strong and improving, and PAT margins are also improving. Prestige and above volume growth is decent, and that trend is continuing month on month. While popular volume declined by 4.6%, the decline has been reduced, but it has been constantly declining now. If you see their charts, it had a rise and it rose after the budget. And generally, it has a big green candle and then it consolidates to let the moving averages catch up. And then again, it has a rise. So this is the normal trend. So now it has risen. I think it will consolidate. So somewhere close to the 20 EMA, which is around 1320 or this can be bought for long term. Next stock is Heritage. So we move from liquor to milk now. Uh, it is likely to report revenue and EBITDA CAGR of 15.5 and 59.3% over FY24-26. Return ratios of Heritage to steadily expand over FY24-26 with higher margins. Value-added products contribution to total sales, excluding ghee and butter, increased to 37%, 210 basis point year-on-year growth, led by strong distribution. Company targets to scale its value-added products contribution to 40% of total sales. EBITDA margin scaled to 9.1%, plus 472 basis point year-on-year, led by lower milk procurement prices. Average milk procurement prices was down rupees 3.47 per liter year-on-year, whereas selling price was up 0.22 rupees per liter year-on-year. So that helped the margin. The company has further expanded product portfolio in lassi, sweets, and ice cream segments with several launches during the quarter. Focus on new product development, brand building activities, and distribution network expansion continued in Q1. So if you see here, their revenues have grown around 11% year-on-year and 8.6% Q-on-Q. But the EBITDA margin has improved drastically uh, and EBITDA has grown 32% year-on-year and 32% Q-on-Q. And EBITDA margin has nearly doubled over the last year, which has led to a PAT growth of 249% year-on-year and 46% Q-on-Q. So which is the one which is driving the stock. Now, if you see here, their margins are going to steadily improve and they're going to do around 5,064 crore of net sales in FY26. So margins are improving and net income is expected to be around 270 odd crores in FY26. Key ratios, EPS is expected to be 29 to 30 rupees. So at 20p, it can easily trade at 600 rupees. And EPS growth is around 34. ROE is expected to be better. ROE, ROC are all going to go up and going to be in 20 plus now. So that is positive and that will drive profitability. So if you see, there is a strong revenue growth, which was at normal 6% CAGR till FY24, is now it's going to become 15%. EBITDA margins are also improving every year, and now it is about to reach double digits. PAT is improving, which was moving at around 8%, is now growing at 60%. ROE, ROC are also on upward trajectory and likely to be around 20% plus. See that chart, it had a rise after the election, but then it consolidated. That was a good opportunity to get this. So anything closer to 20 EMA, that is 550, 560 should be a decent level to accumulate this stock for long term. I have finished. We'll take questions now.